Hi guys, Harry Yotis here, professional trader for 20 years now. Started my career in 2005, still alive in 2026. So today, Tuesday, May 19th. May doesn't look so good so far. We punched the highs and then we're giving it all up, and it's basically because of interest rates and inflation. Okay, we crossed Rubicon, if you will, recently, and we'll get to that and the implications of higher interest rate on this economy and the market. And it is a big deal. Okay, you'll see why going forward. But first, let's talk about the technical picture. We always do that. Okay, despite interest rates rising to highs, okay, in the long bonds, we still have the market relatively high. Okay, this market is very, very strong. Okay, it is, although today we're down another 0.67% on the S&P 500, it's still holding this bullish pattern. Okay, if we bring in the moving averages, we're just today crossing below the 10, okay, the 10 exponential. Well above, okay, we're very stretched above the 50. This can go higher as the days go on, as the days go by, but still above the 20. It is a very, very bullish configuration. Okay, technically speaking, nothing has really changed. The market is shrugging off these interest rates. Okay, and we always pair it with the sentiment. What does the sentiment say today? 61. We're getting close to ending the greed phase and going into the neutral. Some of the sub indices that we talked about, we still have market momentum at extreme greed because the uptrend has not been broken. Strength now is back down to fear, and we warned that the breadth is going to get to extreme fear. We could get a buying signal right here. Okay, even though the put call ratio, this is lagged 5 days, so you'll probably see it more at greed or neutral going forward because it's sort of recycling into that stage. So we do have still in greed. However, some of the sub indices are showing fear, which is like in this bullish configuration. If we go lower and cover the gap, we're going to get into extreme fear on some of the indicators, which would be a good long or buy signal, which is very, very strange at these highs. Okay, so yes, the sentiment is at greed, but not tremendously so. And we showed before in the AAII sentiment index, which we'll get this week, that the bears are still lingering. Okay, so any down move, I think, should be a buying opportunity. Okay, so let's get to today's main topic, and what's scaring the market is interest rates and inflation. Okay, we know it's all because about the war. So we look at oil first. Oil is creeping back higher. We're at 104. Still hasn't broken this choppiness around the 100 level. Okay, but it's creeping higher. Okay, the longer this, we said, Trump is on a clock. The longer this war goes, the higher these interest rates will go. It's all because of oil and inflation expectations, which means interest rates are high. Okay, so we know that oil is there. So what are all the offshoots of this oil trade? Okay, it's the US 10-year, the benchmark. This is the interest rate that's really scaring people. We're coming back now and approaching these high levels of 4.72. Okay, and the outside chance of 5%. 5% is a huge level. If we get there, this market, I don't think will hold up very much. Like again, Trump is on the clock, unless something is done with this war. These interest rates are going to creep higher. Okay, as the price of oil creeps higher, and we'll get into a danger zone. Okay, this is the U.S. 10-year, but you have the U.S. 30-year, which is at highs. Okay, 5.17% the 30-year, and RSI is overbought. Every time we get to these conditions, there's always some kind of pullback. So we're stretching it. We're pushing into this like red zone, if you will, that something has to give. Okay, and we have on CNBC, we have all the mortgage rates surge to highest level since July. It's because we saw all of these rates going to highs. The 30-year is at 5. The 10-year was at 4.72. Okay, approaching highs. A 10-year at 5%, we'll see the 30-year at 5.30, 5.40. It's going to be danger zone. Okay, Trump is on a clock. Okay, and what does this all mean? Well, today we crossed the Rubicon. If we go to the FedWatch tool, these are the interest rates for the FedWatch. I clicked it on December of 2026, and look, this column right here is 3.75. This is a hike. Remember before this was in the 60s and 70s. This is no hike. 3.5%, which we're currently at. Now, finally, the odds of a rate hike have surpassed finally the odds of standing pat. If this goes much, much higher into the 60s and 70s, the market is going to be going down. Okay, it's going to be going down, and it's going to be going down fairly hard because we went up parabolically like this. Like if we look at the SPY, we went up parabolically this move, 18% in like a month and a half. This could easily get cut in half and revisit the 700 level if things start progressing slowly. Like we're going to have interest rates like the US 10-year go slowly higher and then accelerate. Okay, it's going to go slow, just like oil. US oil is going to slow, and then break the highs past 116, 120, and then keep going. You're literally on a clock, and the interest rates here, especially right now, market participants are saying 41% chance of a hike. Once we start hiking, we get into a hiking cycle. It's not just one hike and then that's it. Okay, so the Fed or the market is basically telling, not the Fed, this is the market, because the market expectations are 41.7% because the long yields, the US 10-year and the US 30-year are spiking. It's the market that is forcing Trump's hand, not the Fed. The Fed is going to follow suit. The Fed cannot ignore the market. You can have a really steep yield curve if the Fed stays pat. Okay, and they might have to. Okay, this is very, very dangerous. Okay, if you have interest rates at 4.65%, okay, and you have the 30-year at 5%, okay, the U.S. government is at a $39 trillion deficit. Okay, the debt to GDP is over 130%. Okay, we're in the danger zone. We can't sustain this for much longer, especially since in the next 12 months, about a third of the debt has to be refinanced. So imagine a third of the debt has to be refinanced at 5%. Like a third of 40 trillion times 5%, that's like $600-700 billion extra in interest rate charges. Okay, we already have a $2 trillion deficit. Add another 600 billion to it just on interest, just on if rates stay at these levels, it's like the clock is on. The clock is on. You're seeing it through multiple directions. You're seeing it through the 10-year. You're seeing it through oil, which is the catalyst. This is what's doing it, and it's all because of Trump's war on Iran. There has to be a deal soon, or this market, I'm saying it right now, this market will not sustain. Okay, however, okay, having said that, if the deal goes through, this market's ripping. Okay, so at this point, you should still be net long because nothing has really changed. However, you should have some short exposure. And I've talked about it 1,000 times, how to have short exposure with options while still getting a net credit. There are many things you can do instead of just buying puts. Okay, you could do that, but there are ways to go short while staying, like we mentioned before, if the market goes down to here, to the 700 level on SPY, we'll be making the most on our shorts and we'll be covering that trade. Okay, so you want to have some short exposure, but still be net long. Okay, and that's it. That's the whole story. This is the position that you should be having going forward. All because we are coming into the interest rate red zone. Okay, the war, oil prices being high, are telling us that. Well, it's really the bond markets are telling us. It's nothing else. If you look at the bond market, which is set by the market, this is not a controlled rate. This is a market rate. This is not the Fed controlling these rates. Okay, and they're screaming higher. This is the benchmark. The US 10-year is the benchmark for stocks. Okay, and the US 30-year is the benchmark for mortgage rates, long-term mortgage rates. So those things are at highs. The US 30-year is at highs. Guys, like we keep saying, Trump is on the clock. We've been saying it for a week or two. He can't just keep talking his way out of it now. He has to open up the trade. He has to get this guy, US oil. He has to get this guy down. And it can't be cosmetic. It can't be like a SPR release or whatever. It has to be a concrete, meaningful steps towards peace with Iran. I don't think nothing else will do it. Okay, otherwise we're looking at a slow grind higher and then a fast grind and then a fast move higher. Okay, so those are my thoughts, guys. Okay, we're in May and it looks amazing, but there are some harbingers of doom ahead. Okay, that we should pay attention to. Okay, so that's it. Let's see what happens on Wednesday going forward. Let's see what kind of news comes out. And remember, Wednesday, tomorrow, is NVIDIA earnings. That too will have an effect. So far, earnings have been amazing. Earnings revisions in the future have been great. This is why you should be net long, because fundamentally nothing is broken. It's all tied to the interest rates going forward and Trump-Iran war. Okay. But basically everything else is doing fine. I can't really have no complaints. So let's see what happens going forward. Later, guys.